All right, welcome back to Michael Burton's Meal Prep Monday. 10 investment strategies, 10 investment, well, not investment strategies, income sections, but we're fitting this is the second part of the investing, and we're going to talk about how the stocks work. Let me kind of adjust this for you a little bit. All right, so you can check out the swag a little. All right. So, how does the stock market work? Interesting. No one knows. Just some FYI. But we have these strategies and analytics and technical analysis. So, how does stock market work? Let's see. Where can I begin? All right. So, companies raise capital for different things. All right. They research and development (R&D) for new products, opening opening new retail outlets for the sale of company products, and or expanding the company's business to international markets. All right. So those are ways that company raise capital or the reason they decide to go public. Potential ways investors can profit with companies. Increase of the stock price, dividends paid to investors. However, profit is not guaranteed, you guys. So keep that in mind. Let me see. I don't want to continue to cut off my meal prep Monday. How about that? If I could raise my chair or something, I would. All right. So two main purposes of the stock market. Provide companies a way to raise capital, offers investors opportunity to earn money. Okay. So when companies go public, they can use any capital they earn from the stock sales to R&D, new products, open new retail outlets, and expand businesses to international markets. So if you've been watching what's going on in the media right now, a lot of the companies are trying to increase the shares to increase the revenue and or buy up new companies for low debt. Stock market basics. Company decides to go public, contacts an investment bank to handle the IPO. The IPO is initial public offer. Initial investors are groups such as pension plans or hedge funds. Investment banks get commitment from investment groups to purchase large blocks of stock. Institutional bankers, institutional investors, what they call them. They call us retail investors. Company pays investment banks for its services. Thereafter, all stock sales occur on the exchange, e.g., New York Stock Exchange. How are stocks priced? Stocks are priced based on supply and demand. Supply, quantity of stocks available for sale. Demand, number of shares investors are willing to buy at a given price. If the supply is less than the demand, the stock price will rise. If supply is greater than demand, stock price will fall. Bid and ask, always buy the ask. Bid is the highest price one buyer is willing to pay among all other buyers. That's the highest price. The ask, always buy the ask, the lowest price at which stockholders are willing to sell. Bull versus bear markets. And now there's a new player called apes. So let's talk about bulls. Bulls attack up. So bull want the stock market price. Bull market is when stock prices are generally rising. Okay. Bears attack down. So this is on your SIE exam also. When stock prices are generally falling. And again, you got your unofficial apes that just don't care about either one of them. They're just buying. They're out of control. Go apes. An overall bull market does not guarantee that a given stock will go up. And bear markets tend to be more severe than bull markets. They fall more sharply than bull markets tend to rise. How to buy stocks. You direct buying and selling through an online brokerage. Have a stockbroker buy or sell the stocks for you. Stockbrokers are licensed through FINRA, which is the Financial Industry Regulatory Authority, FINRA. Okay, buy a portfolio of stocks such as a mutual fund or ETF, exchange traded fund. Picking stocks. Again, that's the risk and reward. No risky, no bisky. Three primary ways to help minimize risk. Careful research and analysis when selecting stocks, diversification, index investing. Index funds are the way to go, people. How people participate in the stock market. Again, you can't win if you don't play. All right. So, just a few of the options to consider when investing in the stock market. Investment goal options. Okay. Capital appreciation and growth, income or cash flow. Okay. Hold time options, short term investors versus long term investors, and management options, active management versus passive management. Why people invest in the stock market are different. They have capital appreciation growth to take money they earn and put it to work to make more money. That is the way to do it. Because again, you have your earned income. So now we're talking about investing income. Again, 10% of your earned income must in turn earn income for the earner, which is you. Income or cash flow to create a supplemental income stream. Combination investing, a hybrid strategy of both growth and income. Investment hold time. So you have your short and your long term. So how long you prefer to hold stock before you sell them. So you have your day traders. Generally, daily profits are intraday, days price fluctuations. You got your short-term investors, hold stocks for a few days to a few months. They're called swing traders. And then you have your long-term investors, which is me. Pursue, buy, and hold stock investing strategies. So hold for the long term. All right. Portfolio management style. So you have your active portfolio management, picking individual stocks based on fundamental or technical analysis, just not by overconfidence or anchoring or herding, also going with the herd. Make buying and selling decisions based on market timing. All right, so those are active portfolio management. A passive portfolio management is usually focused on index investing, the safe route, index funds. Select a portfolio of stocks that mirror the performance of the overall market. All right, so designing your personal stock portfolio, your stock market portfolio. Identify your personal financial motivation for participating in the stock market. So why do you want to? Determine which method of stock selection you prefer, fundamental or technical analysis. Decide which approach you want to take. You want to take the portfolio management, passive or aggressive. And remember that you can combine strategies and approaches. All right, the stock market, types of investing strategies. All right, so ways to buy stock, investment strategies to consider, and investment analysis options. Okay, you guys. So ways to buy stock. You have your buying individual stocks, mutual funds or ETFs. You have your investment clubs and your robo-advisors. All right, investment strategies to consider. Dollar cost averaging. I love dollar cost averaging. Averaging down. You buy a stock at 17. A few days later, it might drop to 9. Buy more. You're going to average down. Have a clear exit plan. All right. So investment analysis options. Fundamental analysis. Technical analysis. 3 decisions about market investing. The exact means you want to use to purchase stocks. Which investment strategy you want to employ. What's your exit plan? Okay, again, we're always talking about exit plan. What's your exit plan to get out the market? Ways to buy stocks. By investing in mutual funds or ETFs, pool the money of many investors, managed by investment companies when you buy mutual funds, okay? Investment clubs. These are typical partnerships or LLCs, groups of individuals, investors who invest through a brokerage account in the name of the club. And you have your robo-advisors, investing software programs that make automated investment decisions on your behalf. How do people evaluate stock market investments? Okay, how do they evaluate it? Fundamental analysis that uses various financial metrics to evaluate company potential for future growth and earnings. Metrics includes earnings reports, profitability measures, liquidity or debt, return on equity, return on assets. Then you have your technical analysis, in which I love when people do the technical analysis. Do not attempt to direct, so technical analysis does not attempt to directly measure a stock's intrinsic value, identifies price movement patterns, and predict future price movement. Dollar cost averaging. Okay, so we talked about dollar cost averaging. All right, so dollar cost averaging, making small regular investments in purchasing a company's shares, investing a specified amount of money per week, per month, or quarter, spreads the cost basis of the stock across times, offers an alternative if you can afford to buy large quantities of stock at one price. All right, so again, having an exit plan. Very few investors buy stocks and hold on to them indefinitely. Yeah, they don't. Get an idea of what would trigger your exit from holding a given stock. Consider actions in a variety of scenarios. What would you do if the stock increased by 50%? And what would you do if the stock decreased by 50%? Getting started investing in the stock market. Think about your personal financial goals and design a strategy to reach them. Consider the best way to put the strategy to work. Make your own decisions or hire a stockbroker. Purchase individual stocks or invest in a fund or join an investment club. Research is the best way, you guys. Research resources to put your plan into effect. All right, investing in bonds. 3 key elements characterize bonds, okay? You got your face value, your interest rate, and your maturity. So the face value is the initial price of the bond, the par value. And you have your interest rate, coupon, annual interest rate paid during the bond life, and maturity, time from the bond's initial issue to the bond's specified maturity date. And again, all these are on the Securities Essentials exams, Securities Industry Essentials, the SIE. So your bond overview. So bonds are debt obligations on the part of the issuer. Return is the interest earned on the bond holder. Governments and companies issue bonds to raise money. The bond value depends on interest rates and the issuer's credit worthiness. Can provide a source of income, may offer tax advantages. 3 elements of bonds. You have your face value, par value, the initial bond price, the principal loan amount paid to the bond holder. You have your interest rate coupon. You have the annual interest paid to the bondholder during the bond term. And you have the maturity, the period of time from the bond's initial issue until its specified maturity date. Most common types of bonds, government bonds, issued by the federal, state, or municipal governments. You have your T-bonds, your treasury bonds, a 30-year long bonds, $1,000 to $1 million face value. And you also have your T-notes, your treasury notes. These are 1 to 10 year terms, $1,000 to $5,000 face value. And then you have your treasury bills, your T-bills, short term, 13 weeks to 1 year, $10,000 face value. You have your zero coupon bonds, interest deferred until maturity. So those are the common types of bonds. You also got some other common types of bonds. So you got your asset-backed securities, your ABSs, debt securities comprised of collection of debts, mortgages. You have your corporate bonds issued by companies, high-yield bonds, bonds that represent high risk, also called junk bonds, fixed or variable rate bonds, fixed rate of interest or variable floating rate tied to an interest index, LIBOR. Risk and bond investing. All right, so there's a risk involved with bonds also. So default by the issuer, potential changes in the prevailing interest rate, the call risk. The issuer may call the bond prior to the maturity date, and the diversification may help reduce the risk. Bond investment strategies. So you got your passive investing. Simply buy bonds and hold them until maturity. Bond ladders. Portfolio bonds with different maturity dates. Total return strategy. Sell bonds when their price value rises. How to invest in bonds. Okay, you got your bond broker, bond mutual funds, and ETFs. Bonds in the fund have different maturity dates. You may have to pay a fund management fee. All right, you also got your Treasury Direct. U.S. government bonds can be purchased online from treasurydirect.com. And you also have your UK investors can buy government bonds directly from the government debt management office. All right, annuities. Woo, that's the way to go. If you got an annuity, run it. Annuity categories. So you have your immediate and deferred for those categories, and then you have your types. You got a fixed annuity, variable annuity, and index or equity index annuities. So what is an annuity? An annuity is a contractual agreement between an individual and a financial services company, insurance, or investment. Secures regular periodic income payments for the individual. So 2 phases: accumulation, when the annuity is funded, and annuitization, when payouts occur. Flexible as to payout structure, and also consult with an agent or advisor to learn how much money to put to an annuity. So the 2 main categories of annuities we talked about: immediate annuities. Begin the annualization phase right away. Good for those at or near retirement. All right, deferred annuities. Deferred payouts to later, to a later specified time. Appropriate if you lack funds to fund the annuity with a lump sum, or you are several years away from your retirement age. 3 types of annuities. Within both immediate and deferred annuities, there are 3 types. You got your fixed annuities. You're paid a fixed interest rate and a fixed payout amount. You have your variable annuities. Your payments vary based on the investment returns. You have your equities index annuities. Guaranteed minimum return. Your gains are capped at a certain level. The risks associated with annuities. Lack of liquidity. You typically cannot cash out an annuity without paying substantial fees. Tax-related risks. Payouts taxed at your regular income tax level. Transaction costs, fees, and administrative costs can eat up your gains. Tax considerations. Qualified annuities are funded with pre-tax money. Payouts subject to full income tax. Non-qualified annuities are funded with after-tax money. You pay income tax only on the interest part of your payouts. Taxable portion is calculated using the exclusion ratio. One exception is annuities purchased with a Roth IRA. Pays are tax-free. How to get started with an annuity. Determine the level of income you need at retirement. Figure on living longer and factor in inflation, at 3% inflation annually. Consider the risk-reward trade-off. No risky, no bisky. Don't be afraid to be creative. Choose a financially sound insurance or investment company. All right, so real estate, risk and reward for real estate. Potential risk and reward for real estate as an investment. So the risk: affordability, leverage, acquisition costs, and liquidity. All right, rewards: leverage, equity growth, income, tax benefits. Benefits of real estate investments: leverage, borrowing money to control an asset of greater value than the original amount you invested. For example, you pay $100,000 for the property minus $20,000 down. So you got $80,000 mortgage, but you control the property. Helps improve your return on your investment, your ROI. Works in your favor when the property appreciates in value. Benefits of real estate investments: equity growth, difference between what you owe on the property and its value minus selling. So example, home valued at $200,000 would cost you $20,000 to sell, and you owe $100,000 in mortgage, $80,000 equity. Equity builds in two ways: value appreciation and mortgage payments. Appreciation occurs on both the building and the land. Paying down the mortgage gives you a steady equity growth over time. Excuse me. The benefits of real estate investments: income. Real property generates income when rented to others, like Airbnb, things like that. Tax benefits. Some rental income is tax-free. A $250,000 match tax-free profit for a single owner. Capital gains. This is basically capital gains. $500,000 match tax profit for married couples filing jointly. Affordability. Many owners find they can't afford the payments. So these are risks. So let's go over some more of the risks. Risks of real estate investing: affordability. Many owners find they can't afford the payments. Leverage works against you if your property decreases in value. So, for example, you buy a home for $100,000, you put $25,000 down for the payment and the closing costs. You borrow the remaining $80,000 from the financial institution. The property decreases in value, decreases to $70,000. You will have to pay the extra $10,000 in selling costs. That sucks. Risk of investments: liquidity. How long would it take to sell the property? In a strong market, 2 to 6 months. In most communities nowadays, it seems like it's 1 or 2 days. Bad market conditions can take years. View the long-term market outlook both nationally and locally. All right, so in conclusion, real estate investment is not a short-term strategy. Do diligence research on any property investment. Weigh the risk against the potential rewards. Consider your risk tolerance level and investment style. Make sure any investment aligns with your long-term goals. And so this concludes the investment portion of your income strategy. Thank you. I'm Michael Burton. Follow me on Instagram, Facebook, Twitter, and YouTube, Meal Prep Monday, and the Meal Prep Monday website, www.mealprepmonday.com. Thank you.